Okay, so we've got this $21,542 of furniture. We've ascertained it's the only 7-year life. The others are 5. We know we can't take bonus against real estate. So we opted to take the $21,000 of bonus against the furniture, leaving us $542. So let's fill this in. How many years? Convention. Oh. Method. Double declining balance. Depreciation. What times what? Maker's depreciation. What times what? Go to your tables. Find me the factor. 1429, I think it is, right? Yep, $77. Depreciation at the end of the year. Okay, CAD-CAM system, CAD-CAM GPS system. 5-year asset. Depreciable basis, is there any reason to believe that it's different from the $95,000? No? Okay, years. 5. This is all the same. Give me the factor for the first year, please. Yep, sure is. Okay, now car. Wish I had my book up here. Okay, first off, what's the first question you have to ask with a car? Well, really any assets, but I'm not going to have personal use on a CAD-CAM GPS system, probably. What's the first question on the vehicle? You're going to see that when we go to the tables and run the math.
How much of it is used for business?
What percentage is business use? Okay, and basically a client's not going to tell you that. They're going to say like, and you've got to get this out. And I record their odometers on as much as I can on Jan 1. Try and get them in the habit. They're going to say, Mike, I put on 18,326 miles, and I think like, 10,000 of those are business. I do the math. Okay, so we know that 75% of the car is used for business, so the depreciable basis is 21,000. Now, let's just kind of go off to the side over here and tell me what the maximum I can take is in the first year for depreciation. 18,000. But can I take the whole 18,000? No, I've got to multiply that number by what? By the 75%. So let's go see what the limit is. Equals 18,000 times 0.75. Oop, it's a little bitty number. Okay, so we're going to compare that to makers. What's the maker's number again? For 5 years? Oh, that's not even in the ballpark. Okay, so here's the scoop. Up until this year, those numbers in year 1 was like $3,800. So a luxury, what they called a luxury car, was really a lot less. This is obviously part of the TCJA that I haven't completely processed. So a luxury car is, just by doing that math, God, that's going to be like a $60,000 rib. So now it kind of is luxury. $50,000 before you get into bonus. Okay, so yeah, so it is truly, I guess, what you would call a luxury car anymore. It never was. Okay, so I'm going to take, obviously, what? The full 4,200. I just did this check over here. If I told you I bought a Ferrari, for $180,000, you would need to do that math. Sure. I just took the depreciable basis, G11, times the 20%, which is year 1 factor for a 5-year car, right? Or for a 5-year asset.
So if you did buy a luxury car, would you miss out on depreciation, or would you?
It would just take you a bunch of years.
Okay. So you would still get.
You'd get it all. It just might take you 15 years.
Gotcha.
How do you know how long it's going to take for a luxury car to depreciate?
You just do the math on it, and you can see, once it gets down to 0, you're done.
Yeah, you see these amounts go down. And so after.
I'm just thinking,
Okay,
if
fine.
I buy a regular car,
Right.
I get it. a large chunk of their value, like as you drive.
So value has nothing to do with depreciation.
I'm just thinking, because like, if you depreciate it slowly, it's better off just to keep the car until it dies.
So let me explain. Okay, listen. So here's the question, and it's worth addressing. And this is, people ask this on all sorts of assets, but cars are a particularly good example because they drop in value so quickly, right? So depreciating an asset, does that have anything to do with valuation loss? No, it's a, how would you describe it to a layperson?
Spreading the expense over a number of years, over
Good.
its useful life.
Close. Spreading the cost of an asset to an expense account over the years you're going to use it, right? It's taking the cost of an asset and spreading it mathematically over the years that you plan on using it. It has absolutely nothing to do with value. Look at real estate. Real estate goes up in value and we depreciate it down.
So it'd be a fixed basis, because you can't do improvements necessarily to a car, can you? Like if you get a new transmission, would that add in?
Sure, I've got a truck and I add a big, spray on bed and a topper or something.
Or if you're using it in a business purpose, getting like one of those wraps or something like that.
Sure.
When you sell a vehicle, would you capture the depreciation like you would?
So that's a really, really great question. So for Kim, I guess is who's listening. So the question was, if you sell a vehicle, do you recapture the gain? And that probably bears taking a really quick look at. So let's take what do we have here? We've got a 21. Okay, so here's another question I'm not sure I can answer. What would I put this car on my books at? 28 or 21?
28.
I'd put it on my books at 28 because obviously I've got to record the transaction, debit card, credit, cash, or debit card, credit, notes payable, right?
But then of course.
But I'm only depreciating the depreciable basis.
And the other part would go to like owner draw or something, right?
I don't want to use this example because I don't know. Excuse me.
I mean, you could.
Well, if you're doing it for a salesman, wouldn't that go like into some benefit of personal use?
Oh, yeah, good point.
Gosh, you guys, let's just come up with an easier example. Yes, because part of that's going to get W-2'd to the guy or gal. Okay, can we just try an easy example to answer Schuyler's question? Also, please acknowledging that I haven't really been in financial accounting for a lot of years. Okay, so let's say I purchased a vehicle in 11-15. Is that clear? There we go. Purchased 11-15. I paid $36,200 for it. Let's make it easier. It's 16. Okay. It's not a mid-quarter asset. What's that mean? It does mean it's half year, but how I bought it in November, so why are you so interested in mid-quarter? Yeah, what's the rule?
You have to buy more than 40%.
40% of what? Not total, because what's not in the number? Real estate, no real estate. So to kind of fine tune your verbiage, you have to have purchased 40% or more of your tangible personal property, i.e. everything except for real estate and intangibles, in the last quarter of the year. And if that happened, then all the assets in the years have to be depreciated according to what? Those special mid-quarter tables, right? So I have to tell you, because this is a big-ass purchase in November, right? I have to say to you, this doesn't constitute more than 40% of the tangible personal property purchases in this year. So now I want you guys to figure out for me, I'm going to sell it for $21,000. Figure out my AD on the car, and then we'll journalize it. Figure out the AD on the vehicle, and then we'll journalize it. 100% business usage. You'd have to know that too.
Shannon, do I have your?
Software is too harsh on them.
I know. This is a really tough tax return. $40,000 tax return.
Well, that makes sense. That makes it compared to a number. Okay, cool. Yes.
No, this is a stretch project, for sure.
So it's a good thing, I'll want to put some money around.
Oh, so math.
Nope, it's gonna be, yeah, because that's the basis. The basis is gonna be down. So would you take depreciation on that last year too, since you sold it? like-
Certainly, yep. You always depreciate an asset through date of sale.
Okay. So would you go down to days or would you just take months?
Go ahead and take a full year. Good question.
Okay.
Okay, so the factors for the first year are 0.2, second year 0.4, 2016, 2017. What's years 3 and 4?
19.2 for year 3 and 11.52.
Thanks. Isn't that year 2? No.
32.
32, thank you.
Yeah.
I just pulled that off the top of my head. Because that's what I thought it was, but evidently it's not. Okay, so let's add up the percentages, 0.2 plus 0.32 plus 0.192. Oh.
Are you really identify with that?
Okay, so we've depreciated at 82.72%, right? Well, year 1, 20%, year 2, 32%, year 3, 19.2%, and year 4, 11.5, that's 82.72%. Thank you. Times 21,000, so that's the amount that's going to be in my AD account, right? No,
No.
36.2, pardon me.
That makes a difference.
I did this.
So this is how much is in my, let's just round. 29,945 is in my AD account, right?
I got, yeah, 20.
36.2 times 0.8272 is 29,945.
I took my long one on.
So, Schuyler's question was, first off, so make the journal entry. I'm selling this thing for $21,000. You're an accountant, you can't hate journal entries.
That's
Not
my
all.
only favorite part of it.
Like being a nurse and saying I hate blood.
My 8-year-old passed out when she stopped running to be
Okay, 2 debits, 2 credits, right?
So does that mean if we got like journal entries for an online?
Yeah.
Kind of ish. I mean, there's lots of other things you can do with accounting, like pure taxes or managerial accounting, or, sit and process AP all day, every day. If you do a module, you'll never get near a journal entry. I'm an AR clerk, I'm an AP clerk, I'm a payroll clerk. But if you ever want to scale up to doing general ledger accounting, where you bring it all together, obviously you're going to need to journalize.
So journalizing is actually really easy if you just count them out.
My job, yeah, I think I did process scholarship.
Yeah.
So back in the day, when I had the system.
Right.
School, journal entries, debit credit stuff. And I was going through a whole bunch of like old paperwork.
Yeah.
Shred,
Uh-huh.
and I found some old accounting paper.
Oh.
And I was like, I'm totally keeping this. And all I know I was like,
It's weirdly nostalgic for me.
yes.
Because I was like y'all's age when I, was going to school and doing, the old. Okay, so we know we've got to pull the AD off of the books. Debit or credit to pull the AD off? Really?
It's a normal balance.
How do you pull AD off the books? Yeah, debit it because it's a credit type balance. What else do I have to get off the books? The car. What else do I have to put on the books? So I'm assuming, okay, just to get back, you're correct, Amanda. The first journal entry before I sold the car would have been to debit depreciation expense credit AD to get it up to point of sale. I'm assuming I've done that because I took this 4th year, didn't I? But yes, that's always the first journal entry.
So you put the sale requirement.
So what do you want me to do? Debit or credit what?
Credit the cash.
Really? I'm paying somebody to buy my car?
Debit.
And the plug entry, which we could have also figured out is the difference between amount received and adjusted basis, is to a what? I think it's a credit. Gain on sale of auto. Now, tax ramifications. 29,945 plus 21,000 equals minus 36,2. So to answer your question, Schuyler, this is going to be taxable as a, yes, I have to think about this. Tangible personal property, it's called Section 1245, and it will be taxed at capital gain rates. It'll all be taxed at capital gain rates. So the answer to your question is, if this was commercial property, that AD would be recaptured at what rate? 25%. That is not a rule with tangible personal property. This gets a little beyond our scope, but tangible personal property used in a business is called Section 1245 property, and it's the best of all worlds. If you sell it at a gain, 1245 property at a gain, it's taxed at capital rates. If you sell it at a loss, you get ordinary loss. You see how that's the best of both worlds? Because then it's not like limited to that 3,000 and blah, blah, blah.
Doesn't matter how much the gain is, like, it's
Nope.
like $10
Nope.
gain, you're still good to go.
Nice. Right on.
Okay, you bet. Good question.
So I suppose actually what would happen at the end of that year is the depreciation expense would be on the books for that full year. And they would also be taking that, because you said to take full year for that last, since they sold it so late in the year.
I'm sorry.
Is that correct? So on their taxes that year, they would have depreciation expense for a full year on
Yeah.
that car as well as the gain?
Right, and those would really, well, not even really. Yes, that's exactly what would happen.
And so you would net those two?
No, you wouldn't have, because the depreciation expense is going to show up in your Schedule C,
Right.
or your 1120S, or your 1065, depending upon your partnership or an S corp or whatever. Yeah. Super good questions. You guys are actually probably asked the most in-depth questions of any tax class that I kind of can remember in recent history. Okay, so depreciable basis, any change on these guys between
You're also an offer spot.
495? So these guys are simple, right? Laptops and smartphone, what do I do with them? I don't think they're 7-year assets. I think 5-year assets. Okay. I don't know. So let's do this now. Now you need to get this to your 4562. Oh, let me just quickly explain now. Here, now let's jump in and do the intangibles. I do want to make sure that we touch on that based on this guy. Okay, intangible assets. An intangible asset is amortized, not depreciated. It's something you can't touch. You know what they are. They're patents and franchises and trademarks and copyrights. And in this, the example that I had up there was a covenant not to compete. I see one of those every couple years. Where do I see them? Covenant not to compete. What's that mean?
Is that like if you're hired or like you quit a job or something and you're like, well, I'm not gonna work for, like I quit McDonald's, I'm not gonna work for Arby's.
They can't actually do that to an employee because it's taking away your ability to earn income. But what is it? Statutorily, I can't do that. I can't say, listen, if you leave me, you can't go nurse for anybody else. Okay, right now, in fact, did you guys see that there's a current case in Montana right now. We're having a really hard time filling nurses in rural hospitals. And so there's a pipeline in the Philippines. So companies, particularly at nursing homes, go to the Philippines, recruit Filipino nurses, maybe help them get their certification, or do help them get certified in the United States, help them get up to speed with English, and then they bring them over and they tell them you've got to work for 5 years at Village Healthcare or whatever, because they've invested a lot of money to get them here and get them up and productive. And one of the gals here in Missoula just quit after 3 years or was let go, and they're trying to recoup all of those costs I just described. And it's going to be interesting to see how that moves through the courts, because there's a little bit of indentured feeling to that whole scenario that I just described. A covenant not to compete is if I buy your business, right? Or, sorry, if you buy my business, and then you say to me, say that I sold you a gym or a Pilates studio, and I've got a very specific way of doing Pilates, and you just paid $400,000 for it. You don't want me to go down to the corner and open another Pilates studio. So you can make me sign a covenant not to compete for 3 years, 5 years, 7 years, within a 20-mile, 50-mile, 100-mile radius.
So for the person that you're buying it from, so they don't go.
That's an asset, and it's an asset to you that I can't go into business and compete against you. So it's written right in the buy-sell to the business.
I was gonna say, that's something you would negotiate during the.
Absolutely.
Okay.
The two big things that I write off for intangibles are covenants not to compete and goodwill, which is what?
Blue sky value.
So give a description of that with the Pilates studio. What would be blue sky?
Basically, you're taking on a lot of extra clients or something, or basically there's
Like
like,
client list.
intangible, like, value that comes with a business that isn't just brick and mortar sort of stuff.
I was wondering, that was my question, was about like pointless, is that like an intangible?
It is.
Okay.
If I had a Pilates studio here, I'll use a yoga studio. In downtown Missoula, it's been on Front Street since I was in college, so it's been there for 38 years. It's had literally the same yogis that I went to in college. These women are now in their late 70s, okay? So you've got long-term employees, you've got clients, you've got a great location, you've got great naming. When she sells that studio, there's no assets in a yoga studio. I mean, that's kind of the whole point. There's nothing but a nice floor and a Buddha and some little lighting, right? So she's got no hard assets to sell, but I bet you she can get $300,000, $400,000, $500,000 for the name yoga studio on Front Street in Missoula, Montana. So her whole sales price is going to be goodwill. So what do we do with them? They have to be amortized. They have to go over 15 years. And in just kind of a weird, quirky thing, remember how we learned about 179? This is 197. And can you pull a 4562? I want to show you where it goes on it, because it's completely different from where the rest of your assets go.
4562.
Your 4562. It's all the way on the bottom of the second page. It doesn't go up with your other assets, because it's not depreciated, it's amortized.
Where does the money and the dollar amount come from? Like,
You negotiate it. Harriet's gonna come out and say, I want $1 million for the name, and I'm like, I'll give you 50 grand, and then she goes 950, and I go 100, and then da-da-da-da-da-da.
So it's really only determined by what somebody.
What you're willing to pay.
Yeah.
But, okay, so there's a little bit more math to it than that. You're actually gonna do something called business valuation, where you're gonna look at future earnings. So if I'm gonna buy the studio from Harriet, she's gonna give me a P&L.
Yeah.
And I'm gonna look at the P&L and I'm gonna say, you net $85,000 a year. And your trajectory has been going up 3% a year. So I'm gonna project 5 years into the future, or 3 years, or 7 years, based upon what I want to assure myself, and I'm gonna present value back those future cash flows. And that's gonna be a piece of the business valuation. Okay.
Gotcha. But that's done by that's usually done by like a third party or something, right?
We hire Andersons or Newland.
Yeah.
But I'll do small clients, like, I'm selling that, I worked with the guy that sold the pizza place next to the Greyhound bus station.
Oh,
I can't remember what it's called anymore.
yeah.
It's been some years.
Yeah.
Was it gross?
Yeah.
Oh, I'm sorry. I helped him kind of do the valuation on his business, because he didn't have a couple grand to go pay a CPA firm to do it.
Yeah.
But I would never do it for, like, you're selling your medical supply business or something. I would absolutely be like, you need to go to a business valuation professional.
Yeah, if it's just Joe and Bob trying to figure out.
With your nurse situation, I was kind of unrelated-ish, but with that, did you say that they had a contract?
They did have a contract, but it's contract enforceable. Amanda, you can't work for anybody else for 5 years. Is that an enforceable contract?
What if the contractor said that you can, but if you quit?
You have to reimburse them for the cost. That is what's being contended.
But she was fired, right?
Yes.
So that,
That's all I know about it.
I don't know.
You're gonna have no more information forthcoming. I think it's
This is not
interesting to
illegal.
watch.
Yeah.
Would that help anything? Would it be in a similar situation to where, like, if you went into the military and they told you, okay, you're schooling, you have to.
My blanket statement to anything to do with active services is, it's a whole own special set of rules that you would need to research, but it really is.
My other question was, would covenants not apply to if you're opening a new branch? Like,
No, you have to purchase a covenant not to compete. That's a really good question too. You can't internally generate, in other words, internally book any intangibles except for software licenses or software, what do you call them to get IP on that piece of software?
Copyrights?
Is that what they are? Yeah. So in any intangible situation, you have to purchase it from somebody else. In other words, if I'm sitting there, say I'm writing the greatest rock opera in the world, and I think it's going to put Tommy and Jesus Christ Superstar to shame, right? And I think this thing's worth $10 million. I can't just book that one day and start amortizing it. But if I do write this rock opera and then I go to Sony and they want to purchase it and they give me $10 million, now I've got an amortizable intangible.
No, you don't, they do.
They do. And I have $10 million.
It's right on the bottom.
Yeah.
A very tangible $10 million.
Self-created, thank you. Okay. So did everybody find it, 4562? Go to the second page, all the way on the bottom.
So, just a second, on this, what you're saying though is,
That's for 197 still.
okay, but with the, software, like they create, like Microsoft, like if I create Microsoft, I can start appreciating that? Or,
Amortizing.
amortizing it? Okay.
But and again, this is totally beyond my scope, because how do you put a value to that? So
Yeah.
you're obviously gonna need a third party, like appraiser of some sort, although that's probably not the right term, to come in and do some sort of documentation that the IRS would find acceptable, to put a dollar value to that. Okay, I'm gonna put $1 billion on my books and start amortizing it against revenue.
Your boss has to figure that out until they need a tax return.
Yes, there you go. That's my answer to everything. Okay, so now the other thing I didn't tell you, and then I'm having you do this example and we'll move on, is that, so 15 years, beginning in the month of purchase. 15 years, straight line, beginning in the month of purchase. Fiona Ware purchased a small artesian textile company in May 2018 for $980,000. 54 of the purchase price was allocated to goodwill in the buy-sell. How much goodwill may Fiona Ware amortize in 2018 and in 2019? No, 15.
Oh,
15.
never mind.
15 years, straight line, section 197.
Definitely heard that.
So if, say you purchased it in the beginning of May versus the end of May.
Doesn't
you
matter.
get the whole month.
Anytime in May, they get the whole month. And I actually counted, I think, there's May, June, July, August, September, October, November, December.
I did that.
Because if you just say May's the 5th month of the year, and 12 minus 5 is 7, that's not right, because May's in it.
I did that.
Gotcha. Use money.
You wanted 2018 and 2019?
Yes.
please.
And I can't tell you exactly what it is, but when you have a, I have to look this up every time, when you have a buy-sell that's got an allocation to covenant not to compete and or goodwill, you have to put a attachment on your tax return that like pulls the section from the buy-sell that shows the allocation.
I think I'm doing it wrong.
Oh, it's super easy. How many months is 15 years? 15 times 180 months. So I'm just going to take 54 grand divided by 180, and that tells me how much depreciation I get a month. $300.
Oh, I thought they were different.
And in 2018, how many months do I get? 8. And in 2019, I get 12. So it is that easy. It is that easy.
So have lots of these on.
Well, so, but I still want you to tell me where exactly it goes on your 4562.
Down here.
Yeah, part 6, and again, make sure that you understand the difference between line 42 and line 43. Line 42 is if you purchased the covenant or the franchise or the whatever this year. Line 43 3 is for everything that's intangible that you purchased in prior years. So let's look at the little boxes on part 42. So in this example, description of cost would be goodwill. Date amortization begins would be 5/2018. Amortizable amount would be $54,000. The code number would be 197. Application period would be 15 years. And then that final column, amortization in that first year would be 2,400. And then in the second year, you just put 3,600, but that would go down on line 43 with any other examples.
C, the 2,400?
Yeah, amortization. No, amortizable amount is the 54,000. That's like depreciable.
Right, okay.
Yeah. Okay, so let's take what we just learned here and finish this depreciation schedule here. I bought a covenant not to compete for 50 grand on March 5th of 2015. I want to know how much I want you to fill all this stuff in, and then I want you to calculate AD, even though it's not really AD, it's accumulated amortization. And maybe to make this appropriate, we really should put that in a separate. Oh.
And is it always 15 years?
Yep,
Always.
yep. And then once you do that, I want you to start taking these assets to a 2018 4562, like pencil it in. These assets need to now go to the 4562. And actually, maybe I'll send you home with that so we can work on the software in here. Sure. Why don't I just leave you with this? And then let's use it the next hour to work on the software. Right? So this isn't graded or anything, this is just, working together on it.
Are we gonna have to do this for the test?
Yes.
Okay.
And we're gonna do another one of these on Thursday.
Will we do this in Excel on the test?
Yes. Yep.
And then we'll have to print it out or email it to you?
No, you'll use it to fill out a 4562.
Gotcha.
But yeah, and probably email it to me. Sure, because otherwise how will I see what you did? Yeah, good question.
So you can't just check our answers real quick? Because, is it?
No, if you give me a 4562 and your numbers are all off, how do I know if you got one little thing wrong or all 8 assets?
Well, yeah, can we just check the number though that's supposed to go in?
Oh, here?
Yeah,
Sure.
might as well.
So let's see, 15, 16, 17, 16, 17, and 18 are full years, right? So 36 months plus 10 months from 2015, so 46 months. So 50,000 divided by 180 times 40 months, right? That doesn't sound right. Oh, I forgot a 0.
I got 12. Wouldn't that be?
50,000 divided by 15 years, he gets a full year in 2018.
Wouldn't you want to break it into months though?
I didn't here because I didn't have to.
So you would get that full year for 2015?
No. I meant this is a 2018 fixed asset schedule.
So we're only doing it for that year?
I'm doing, these are the numbers right here that are going on my 4562 for 2018.
Right.
Yeah.
Oh, yes.
So you're taking this schedule,
Yep. I got it.
and there's only one prior year asset. Everything else is a current year. Got it?
Yeah. So I'm sorry, I was going for the accumulation.
Yeah. So the AD I did. I took 50,000 divided by 180 months times 40 months. 3 full years plus 10 years in 2015, right? So 46. The minute I said that, it's like, okay, that's not right. Yeah, 46 months. Okay, so let's turn, I'm gonna save this, promise, and put it up, promise. And then let's turn our attention to our cases. Do you have 2 or 3? 2, yeah, okay. Okay, great. One more time?
The total cost.
This guy? Yep, so 50,000.
180 months and 15 years.
Oh, actually, it needs to go over here, doesn't it?
Oh, okay, yep, okay, I got it now.
Okay, I'm gonna save this. I am going to upload it. Watch me do it.
That's how much you get per month.